begins on a Sunday night when the markets are closed and nobody is really paying attention. In this story, the first hint doesn't come from Wall Street or London, but from a short, almost boring press release in Mexico City. It mentions temporary export controls on selected strategic minerals and lists, almost as an afterthought, one metal that changes everything: plata, silver. Traders who actually read the Spanish version realize what the English summary glosses over. Mexico, the world's top silver producer, is about to hit the brakes. Now, as of late 2024, Mexico has not actually imposed a full halt on silver exports. What we're exploring is the financial logic of what would happen if it did, or even if it threatened to. The reason this hypothetical matters is simple. Sometimes markets move not on what has already happened, but on what might happen next. And this particular might could be seismic. Imagine waking up Monday to a world in which the largest source of mined silver to global markets suddenly looks uncertain. Mexico accounts for roughly a quarter of global mined silver production, depending on the year and the source. Silver flows out of Mexico in steady streams. From mines in Zacatecas and Durango, from polymetallic operations, where silver is a byproduct of lead zinc or gold onto trucks, into rail cars, to ports, and then to refiners and manufacturers all over the world. It's not a flashy commodity like oil, splashed across every geopolitical headline, but silver is embedded quietly into the backbone of modern industry. Solar panels, electronics, medical devices, electrical contacts, even your smartphone camera. Pull on that quiet thread, and you tug on a lot more than just coins and jewelry. The logic hook here is that silver sits at the intersection of two worlds. It's both an industrial input and a monetary metal. When you stress either side of that identity, the other side reacts. That, on sense why a Mexican policy shift, even when framed merely as temporary controls or licensing requirements instead of a clear-cut ban, could create outsized waves. On the surface, the government might say, we're just reviewing export permits, or we're prioritizing domestic value addition. But markets don't trade on soothing language. They trade on risk, on probabilities, on what could go wrong. And the one thing commodity markets hate more than bad news is uncertain news. A complete, officially announced halt would be brutal, but clear. A vague, half-explained slowdown is a fog bank that invites speculation, hoarding, and panic. Inside Mexico, the official rationale might sound perfectly reasonable. Policymakers could argue that for decades, the country has exported raw or semi-processed materials only to import finished products at a premium. Why keep shipping out strategic metals at low margins, they might ask, while other countries lock in the high-value manufacturing of solar cells, electronics, and emerging green tech hardware? The message could be framed as economic nationalism with a development twist. We are not against exports, we just want more of the value chain inside our borders. But underneath that explanation lies a far more powerful lever: control of a bottleneck resource in a world scrambling to decarbonize and digitize. On Monday morning, the first fires start in the quietest corners of finance. Commodities desks, physical traders, refiners, mid-sized electronics manufacturers who never thought they'd need to scan political headlines from Mexico. The question they all ask isn't, has Mexico stopped exporting silver? But could this be the start of something bigger, and can I afford to be on the wrong side if it is? Futures markets are leveraged mirrors of expectations. A rumor of reduced exports, once it's deemed credible, doesn't have to actually shut a single mine to move prices. It just has to shift the perceived risk. If traders believe there is a higher probability of disruption, they will pay more today to insure themselves against tomorrow's shortage. In that environment, silver's dual identity starts to distort the lens. Industrial buyers worry they might not be able to secure enough metal at predictable prices for next year's HIUS production runs. At the same time, investors and speculators, already primed by years of monetary experiments, inflation scares, and central bank activism, see an excuse to reframe silver as a scarce monetary hedge again. When a metal that already has a tight supply-demand balance gets hit with a credible threat from its largest supplier, narratives accelerate. You don't just have a commodity supply story, you have a financial story. One that can be summarized in a single chilling line. What if this is the silver version of the 1970s oil shock? Yet the most unsettling part, from a financial perspective, isn't actually the immediate price spike that might follow such an announcement. Sudden jumps, while painful, are at least comprehensible. The deeper problem is structural uncertainty. Mines don't stop and start like a faucet. Investment cycles in mining stretch over years and billions of dollars. Trade patterns, shipping routes, refining relationships, those are slow-moving pieces. If Mexico signals that silver exports are now subject to political discretion, not just market forces, then every balance sheet that depends on stable silver supply has to be re-rated. Picture a solar panel manufacturer in Asia with thin margins, working on multi-year contracts priced in razor-thin increments per watt. If silver, a crucial component of the conductive paste in solar cells, suddenly becomes more expensive and more unpredictable in supply, those margins evaporate. Picture an electronics producer whose just-in-time supply chain assumes silver paste arrives every week at predictable prices. That assumption is now broken. These are not nice-to-have industries in a green transition, they are central to it. Which means that a Mexican move on silver exports is not just a local policy tweak. It is a signal that resource nationalism has reached into the heart of the energy and tech transition. What makes this even more potent is that Mexico's leverage is asymmetric. It doesn't need to shut off all exports to move markets. Even hinting at quotas, new licensing regimes, higher royalties, or domestic processing mandates can achieve much of the same psychological effect. A miner worried about slower permits may delay expansion. A trader worried about bureaucratic choke points may preemptively bid up alternative sources. And as that happens, silver yes price action stops being a pure reflection of geology and becomes a referendum on political will. The suspense builds not because we know exactly what Mexico will do, but because uncertainty itself becomes an economic weapon. By the close of that hypothetical Monday, gold might be up a few percent, but silver, thinly traded by comparison and more tightly supplied, could be up far more. The calm, oversupplied image of silver many investors hold in their heads no longer fits the ticker on the screen. Commentators start using phrases like supply shock, strategic metal, and resource weaponization. Yet the central question still hangs in the air unanswered and unnerving. Is Mexico merely flexing to negotiate better terms with miners and manufacturers, or is this the first move in a longer game that rewrites how and where the silver of the future is allowed to flow? Pulls us back from the flashing price charts and into the quieter wood-paneled meeting rooms where these decisions are actually made. To understand why Mexico might consider slamming on the brakes for silver exports, you have to look at three overlapping pressures: politics, economics, and geology. Politically, resource nationalism is not a new idea in Latin America. From oil in Mexico and Venezuela to lithium in Bolivia and Chile, governments have periodically asserted that what lies in their soil should not simply enrich foreign shareholders and offshore refiners. In a world increasingly defined by strategic competition between major powers, resources are no longer just revenue streams. They are leverage points. Economically, Mexico has an uncomfortable truth staring back at it in the mirror. For decades, it has been a reliable exporter of raw or semi-processed commodities and a manufacturing hub for foreign supply chains, especially for the United States. Yet a large share of the value-added, design, technology, branding, high-margin manufacturing has resided elsewhere. When policymakers think about silver, they see trucks leaving with concentrate or doré bars and returning in the form of high-margin finished products: solar panels, advanced electronics, medical imaging equipment. Why, they ask, should Mexico continue exporting the foundation of these industries, while others capture the good jobs and technological know-how? The geology adds a twist. Silver is often produced as a byproduct of mining for other metals, particularly lead, zinc, copper, and gold. That means silver supply is partially hostage to the economics of those other metals. If, for example, zinc prices fall and some mines reduce output, silver supply can tighten even if silver demand is rising. Policymakers, looking at forecasts that project increased silver demand for photovoltaics, 5G, electric vehicles, and electronics, see a curve that bends upward. They also see that new, large, high-grade silver discoveries are rare and costly to develop. In other words, the world is leaning more heavily on a metal that is not getting significantly easier or cheaper to find. From that vantage point, the temptation to reframe silver as a strategic national asset becomes strong. The logic might go like this: if we continue as we have, we export silver at relatively low margins and import finished goods at higher prices, leaving us vulnerable to external shocks and missing out on domestic industrial development. If we instead restrict exports or condition them on domestic processing and manufacturing, we could potentially foster a local ecosystem of refineries, component makers, perhaps even solar and electronics assembly plants. The catch, and it's a big one, is that the transition from raw material exporter to value-added hub is neither automatic nor guaranteed. The suspense, financially, lies in whether Mexico chooses a gradual, negotiated approach or a hard, unilateral one. A gradual strategy might involve higher royalties, stricter environmental and social standards, and incentives for firms to build smelters and factories on Mexican soil. It might look like export licenses that favor integrated operations. If you refine or manufacture here, you get easier access to raw silver. A hard strategy, by contrast, might be framed as a sudden, temporary export halt, justified by, say, a review of environmental damage, community conflicts, or national security concerns. The former path would be disruptive but predictable. The latter would be a shockwave. Behind closed doors, another spreadsheet is on the table, the federal budget. Resource-rich countries often lean on commodity revenues to plug fiscal gaps, fund social programs, or bankroll infrastructure. If the government feels squeezed by slower growth, higher borrowing costs, political commitments, it may look for quick ways to increase its take from the mining sector. Raising taxes is one way. Asserting control over exports is another. If politicians believe exporters and foreign miners have been enjoying windfall profits from rising silver prices, they may feel justified in rebalancing the equation, even if that introduces volatility in the short term. There is also an environmental and social dimension that can be spun in either direction. Communities affected by mining might push for stricter oversight, remediation funds, or greater local participation in profits. A government can respond by saying, "We are pausing exports while we ensure that mining benefits our people and protects our environment." That narrative plays well domestically and can even attract international sympathy. But the instrumental effect, tighter control over export volumes, is what moves markets. Investors then face the tricky task of disentangling which motives are sincere policy goals and which are cover stories for a deeper strategic pivot. As markets try to interpret these layers of motivation, the logic loop tightens. If traders believe the move is mainly about squeezing more revenue from miners, they might expect a resolution once new taxes or royalties are agreed upon, and therefore price in a temporary disruption. But if they suspect that Mexico's ultimate aim is to retain more silver for domestic industrialization, they must contemplate a more permanent structural reduction in exports. That shift in perception from "this is a dispute" to "this is a new regime" is where long-term positions get repriced. Bonds tied to mining companies, equities of refiners and industrial users, even currencies of countries that compete with or depend on Mexican silver, all become part of the revaluation. By the end of Part 2's internal debate, one uncomfortable realization surfaces for investors. The motivations don't have to be perfectly coherent or unified for the impact to be real. Political ambition, fiscal pressure, environmental concerns, and industrial policy can all mix into a policy cocktail that is messy on paper, but powerful in effect. Even if the export halt is more rhetoric than reality, it might still slow permitting, complicate logistics, or create enough uncertainty to chill new investments. And that leads us straight into the next question markets will obsess over. If Mexico really does slam on the brakes, how does that ripple through the global financial system built on the assumption that silver will always quietly be there when you need it? Shifts the camera from Mexico's internal calculus to the global stage, where silver isn't just a metal, but a backbone of entire financial structures. Start with the futures markets, especially in places like COMEX and the London market, where contracts representing vast quantities of silver change hands every day, often without a single ounce moving physically. These are the arenas where industrial users hedge their future needs, where speculators bet on price directions, and where funds build exposure via paper claims. The quiet assumption underpinning this whole edifice is that underlying physical supply will be globally fungible and reasonably available. When a leading supplier like Mexico looks uncertain, that assumption begins to crack. Consider the gap between paper silver and physical silver. An exchange-traded fund that promises exposure to silver may or may not be fully backed at all times by readily deliverable metal in a nearby vault, depending on its structure. A futures contract buyer often rolls positions forward instead of taking delivery. This works smoothly as long as enough physical metal sloshes around the system to keep delivery obligations credible. But when traders suspect a shortfall or bottleneck, they don't just worry about price going up, they worry about the integrity of the system itself. The question becomes, if everyone suddenly wanted delivery, could the system handle it? A credible threat to Mexico's silver exports instantly tightens that psychological screw. Refiners and industrial buyers, who normally operate comfortably in just-in-time mode, may begin to shift toward just-in-case behavior, securing extra inventory, paying up for reliable shipments, insisting on firmer delivery clauses. This transforms a latent supply risk into actual additional demand, as users buy more than they strictly need today to protect against tomorrow's uncertainty. Financially, that's a double hit. Real-world demand goes up, even as anticipated future supply goes down. The price doesn't just reflect the current balance, but a fear premium layered on top. Industrial sectors are the first to feel the hard edge of this change. Solar manufacturers, heavily reliant on silver for photovoltaic cells, operate in a brutally competitive environment where cost per watt is the lifeblood of their business. A spike in silver prices doesn't just pinch profits. It can render entire business models and project pipelines unviable. Developers of solar farms sign long-term power purchase agreements based on assumed input costs. If silver becomes volatile, the cost forecasts baked into those deals start to wobble. Some projects might be delayed or canceled, especially in emerging markets where financing is sensitive to small changes in projected returns. Electronics and automotive manufacturers face a similar squeeze. Silver is used in small quantities per device, but the cumulative effect across millions of units is substantial. Companies may attempt to engineer around it, substituting cheaper metals where possible, but silver ES' unique conductivity and anti-corrosion properties limit how far substitution can go without sacrificing performance or reliability. In the short term, they have little choice but to pay higher prices or risk supply disruptions. That can translate into higher consumer prices or thinner margins, both of which feed back into inflation metrics and corporate earnings. Two pillars that equity and bond markets watch obsessively. On the investment side, silver's monetary narrative catches fire. Asset managers, hunting for uncorrelated hedges to equities and bonds, might see in silver a story that rhymes with gold, but has a sharper industrial twist. If Mexico AS move is interpreted as part of a broader trend of resource nationalism and supply insecurity, silver suddenly looks like both a hedge against monetary debasement and a bet on the scarcity of a key industrial input. This duality can trigger influxes of capital into silver funds, miners' stocks, and related derivatives, amplifying price moves beyond what underlying industrial demand would justify. Currencies and trade balances don't stay untouched either. Countries that are net importers of silver, especially those with large solar and electronic sectors, could see their trade deficits widen as they pay more for a critical input. Nations that can supply alternative silver sources, Peru, China, Russia, and others, may experience improved terms of trade and increased geopolitical leverage. Mexico itself might benefit from higher prices on whatever volume it still exports, cushioning the fiscal blow of any self-imposed restrictions, but only if the global system doesn't respond by rapidly diversifying away or accelerating substitution technologies. One underappreciated angle is the interplay between silver and gold in investor psychology. Gold is the traditional safe haven, the metal central banks hold. Silver has always been the more volatile cousin, with a thinner market and a stronger industrial role. In a Mexico-driven shock, that volatility becomes both a risk and an opportunity. Highly leveraged players may get wiped out by wild swings, while more patient capital can use oversold episodes to build positions. The gold-silver ratio, a long-time reference point for precious metals traders, could swing violently as silver S scarcity premium waxes and wanes with each new headline out of Mexico City. All of this raises a deeper structural question. Can the global financial system, as currently constructed, smoothly absorb a politicization of key industrial metals? If oil in the 1970s taught markets that energy could be weaponized, a Mexican squeeze on silver would be a reminder that the metals underpinning the digital and green revolutions are no less geopolitical. Banks, insurers, and regulators may be forced to revisit their assumptions about commodity risk, collateral valuations, and stress scenarios. A metal that once sat in the up and over other commodities map bucket on a risk manager ARMS dashboard might suddenly warrant a dedicated red flag. By the end of part 3, the suspense is no longer simply, will silver go up or down? It is, what else breaks if this goes on? Do we see defaults from manufacturers unable to meet contracts? Do we see funds gating redemptions because of illiquidity in silver-linked instruments? Do we see nations scrambling to sign bilateral deals for guaranteed access to Mexican silver, much as they do for oil or gas? Those questions, hanging unanswered, set the stage for the next turn in the story. Who stands to gain? Who stands to lose? And how might each player try to bend the situation in their favor? Zooms in on the winners and losers that emerge when Mexico even threatens to hit the brakes on silver exports. Because in every supply shock, there are those who pay and those who get paid. Start with Mexican miners themselves. At first glance, they seem like obvious losers. Export controls, regulatory uncertainty, and political risk are poison for capital-intensive, long-horizon businesses. Share prices of companies heavily exposed to Mexican silver deposits would likely sell off on the mere rumor of export restrictions. Their cost of capital would rise, expansion plans would be delayed, and negotiations with the government would take on a tense, almost hostage-like tone. Yet there is a darker, more complex possibility. If restrictions are not absolute, some miners could find themselves in a privileged oligopoly, especially if they are able or willing to vertically integrate into refining or manufacturing on Mexican soil. If the state grants lighter restrictions, faster permits, or implicit guarantees to firms that align with its industrial policy goals, those firms might, over time, emerge stronger, capturing a larger share of a constrained but higher-priced market. In that scenario, small, undercapitalized operators and purely foreign-oriented exporters would suffer, while better connected or more adaptable players move up the value chain. Outside Mexico, miners and other silver-producing nations stand to benefit almost immediately. A disruption in Mexican exports is a gift to competitors in Peru, China, Russia, Bolivia, Poland, and others. Their existing production becomes more valuable overnight, and marginal projects that were previously uneconomical at lower prices may suddenly clear the investment hurdle. Exploration budgets increase. Feasibility studies that were on the shelf get dusted off, and capital starts flowing into jurisdictions that only weeks before were overlooked. But that shift isn't frictionless. Many of those countries come with their own political and environmental risks, and investors burned by Mexican resource nationalism will price those more sharply. Refiners and industrial users have a more conflicted role. Those with diversified supply chains and long-term contracts from multiple countries may initially benefit as their weaker competitors struggle to secure metal. Over time, however, even diversified players feel the pinch of structurally higher prices and persistent uncertainty. Smaller manufacturers with limited bargaining power are squeezed hardest, potentially forced to exit markets or be acquired. This is how supply shocks often accelerate consolidation. Weaker hands are forced off the table, leaving a more concentrated set of survivors who have both the scale and the political clout to influence how future rules are written. Financial players split along similar lines. Nimble traders and hedge funds with the ability to rapidly adjust positions can profit handsomely from volatility, buying panicked dips and selling euphoric spikes, arbitraging differences between physical and paper markets, and exploiting mispricings in related assets, from miners' equities to options on industrial firms. On the other hand, structured products and retail investors who entered silver-linked instruments for stability or modest diversification may find themselves grappling with wild mark-to-market swings they never anticipated. Misaligned expectations are often the real source of pain. What was sold as a safe diversifier can start behaving like a high-beta speculative asset. Sovereign actors also emerge as key winners or losers. Countries that anticipated the growing strategic importance of critical minerals and built stockpiles, or at least monitoring systems, will be better positioned. Those that treated metals as a simple line item on the import ledger face tougher trade-offs. Some may attempt to strike direct state-to-state deals with Mexico, offering investment, technology transfers, or diplomatic concessions in exchange for preferential access to silver. Others might pivot more aggressively toward alternative suppliers, even if that means higher political risk or unfamiliar business environments. Diplomacy, which once circled mainly around energy and defense, now has to make room for metals at the negotiating table. Technological innovators, meanwhile, see opportunity in crisis. If silver prices stay elevated for long enough, the incentive to develop thrifting techniques, ways to use less silver per solar cell or per electronic contact, intensifies. Laboratory research into substituting cheaper metals, enhancing recycling yields, and designing products with end-of-life metal recovery in mind gets an unexpected boost. Recycling companies may enjoy a renaissance as the economics of extracting silver from electronic waste or old solar panels shift in their favor. The delay between price signals and technological response is real, often many years, but it is precisely in these shock moments that innovation trajectories are bent. Hovering over all of this is the role of central banks and regulators. While central banks do not typically hold large silver reserves the way they hold gold, they monitor systemic risks closely. A prolonged silver shock affecting industrial output, employment in key sectors, and inflation dynamics could factor into their projections and policy choices. Regulators might worry about concentrated exposures in banks or funds to silver-related risks, especially if loans to miners, manufacturers, or traders start to sour. Stress tests that once treated commodity shocks as peripheral tail risks would need recalibration, acknowledging that a single country's policy on one metal can send ripples across multiple asset classes. By now, the suspense has morphed into a larger strategic question. Is this a one-off drama centered on Mexico and silver, or a chapter in a broader story where nations increasingly weaponize critical resources? If investors conclude it's the latter, they won't simply adjust their silver models. They'll reassess their entire approach to commodities, emerging markets, and geopolitical risk. They will ask whether lithium, copper, cobalt, rare earths, and other inputs to the green and digital economies might face similar politicization. And if the answer is yes, or at least maybe, then silver is only the opening act. Returns to the core question as a kind of verdict with the tension left deliberately unresolved. What does Mexico hits the brakes really mean? And how should a rational observer respond? The first step is to recognize that export halts exist on a spectrum. On one end is a total embargo, explicitly announced, rigorously enforced, and long-lasting. On the other end is a subtler regime of bureaucratic friction, slower permits, case-by-case approvals, opaque quota systems, and occasionally arbitrary decisions that create uncertainty without ever stating, "We have stopped exports." Financial markets must operate in the gray zone between those poles, pricing in degrees of risk, not certainties. For an investor or analyst, the logic hook becomes, what concrete signals tell you which direction Mexico is leaning? legislative moves to declare silver a strategic resource, changes to mining laws that tie export rights to domestic processing commitments, sharp increases in royalties specifically targeted at silver, or public speeches by key officials framing silver as a national security asset, all of these would point toward a more interventionist long-term stance. Temporary measures framed narrowly around environmental reviews or specific disputes might indicate a more tactical, negotiable approach. The challenge is that policy can drift, and what begins as a narrow measure can, over time, harden into a new normal. Strategically, there are three broad scenarios that markets will circle around like vultures around a carcass. In the first, Mexico uses the threat of export constraints as a bargaining chip, extracts better fiscal terms and local development commitments from miners and manufacturers, and then quietly normalizes exports, albeit with a higher government take. Prices eventually settle at a new plateau, some projects shift geography, but the system absorbs the shock. In the second, Mexico commits to a developmental path centered on domestic value addition, accepting lower export volumes in exchange for building a local industrial base. Silver exports are structurally reduced, and the world gradually reorganizes around new supply lines and higher prices, while Mexico hopes its bet on industrial upgrading pays off. The third scenario is the most destabilizing. Policy oscillates. Political administrations change, priorities shift, conflicting factions within the state send mixed signals. Export rules tighten, then relax, then tighten again. In this world, even if average export volumes over time remain significant, the volatility and unpredictability of policy depress long-term investment, both in Mexico and in sectors dependent on its silver. Investors hate nothing more than a moving target. They can price almost any level of tax, royalty, or regulation if it's stable. What they struggle with is not knowing what the rules will be 5 years from now, let alone 20. So how does one respond in such an environment? Industrial users might pursue a portfolio approach to supply, diversifying sourcing across countries, even at higher cost, to avoid overdependence on any single jurisdiction. Investors might shift from pure price bets to more nuanced plays, backing companies that demonstrate supply chain resilience, technological thrifting, or recycling prowess. Policy analysts might argue for strategic stockpiles of critical industrial metals, much like strategic petroleum reserves, not to manipulate prices, but to buffer against shocks and give domestic industries breathing room when geopolitical winds shift. For Mexico, the story is equally fraught with risk and opportunity. If the country manages to leverage its silver endowment to foster a robust domestic ecosystem, refineries, fabricators, component manufacturers, research hubs, it could transform a temporary bargaining chip into a long-term development engine. If, however, policy veers toward short-term extraction of fiscal rents without building institutional credibility or industrial capacity, it could scare off investment, slow output growth, and squander a moment of leverage. The line between strategic assertion and self-inflicted wound is thin in commodity policy, and history offers examples of both outcomes. In the final analysis, the phrase "Mexico hits the brakes" should not be taken simply as a dramatic tagline, but as a mental model for a world where critical materials are no longer neutral inputs traded in a vacuum. They are entwined with national strategies, political ideologies, technological races, and climate commitments. Silver, in this sense, is a test case. Can markets adapt to a future where supply is not just a function of ore grades and capex, but of cabinets, congresses, and community councils? Can investors integrate that complexity without overreacting to every headline or ignoring real structural shifts? The suspense, fittingly, does not end with a neat resolution. Even if Mexico never formally halts silver exports, the mere possibility that it could, and that other nations might follow suit with their own critical resources, changes the way prudent actors must think. The next press conference in Mexico City, the next amendment to a mining code, the next protest at a mine site, each becomes not just local news, but a data point in a global risk calculus. And somewhere, on a Sunday night when markets are sleeping, a new document might be drafted that, with a few lines of legal text, reminds the world that in an age of fragile supply chains and intensifying competition, a metal as old as human coinage can still surprise everyone by becoming the sharp edge of economic power.